studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When a corporation owns a vehicle, many business owners assume that all of the vehicle's costs can simply be paid by the company without creating any personal tax consequences. However, that is not always the case. The key issue is how the vehicle is actually used. If the company-owned vehicle is used exclusively for business purposes, there may be little or no personal tax consequence. But once the employee or shareholder begins using the vehicle for personal driving, the tax rules change. Personal trips, such as commuting, shopping, vacations, or other non-business travel, can create a taxable automobile benefit. In other words, even though the corporation owns the vehicle, the employee or shareholder is receiving a personal economic benefit by being allowed to use that vehicle for non-business purposes. The CRA treats that personal use as a taxable benefit because the individual is receiving something of value from the employer or corporation. This is why the CRA carefully distinguishes between business kilometers and personal kilometers. The amount of business driving does not eliminate the tax consequences of personal use. Even if the vehicle is used mostly for business, the personal portion may still result in a taxable benefit. As tax preparers, one of the first things we review is whether the company-owned vehicle was used for personal driving and, if so, how much. That information forms the basis for calculating the taxable automobile benefits that apply under the Income Tax Act. In the next section, we'll see that these taxable benefits are divided into two separate categories. The standby charge, which relates to having the vehicle available for personal use, and the operating cost benefit, which relates to the corporation paying the operating costs of that personal use. The key takeaway is simple. Owning the vehicle through the corporation does not automatically eliminate personal tax. Whenever a company-owned vehicle is used for personal driving, it may create taxable automobile benefits, even if the vehicle is used primarily for business. When a company-owned vehicle is available for personal use, many people assume there is only one taxable benefit to calculate. In reality, there are two separate taxable benefits, and each measures a different type of personal advantage received by the employee or shareholder. The first is the standby charge. Think of the standby charge as the benefit of simply having the company vehicle available for personal use. Even if the vehicle is not driven very much for personal purposes, the fact that it is available for personal use can itself create a taxable benefit. In other words, the tax is based on the availability of the vehicle, not just the kilometers driven. The second benefit is the operating cost benefit. This applies when the corporation pays the operating expenses related to the personal use of the vehicle. These expenses may include fuel, maintenance, repairs, insurance, and other day-to-day operating costs. Here, the taxable benefit arises because the corporation is covering costs that would otherwise have been paid personally by the employee or shareholder. Although both benefits relate to the same automobile, they are calculated separately under different rules. The standby charge focuses on the benefit of having the vehicle available for personal use. The operating cost benefit focuses on the corporation paying the costs associated with that personal use. Because they measure different benefits, it is entirely possible for both calculations to apply at the same time. As tax preparers, it is important to remember that these are two distinct calculations. One does not replace the other. In the following sections, we'll learn exactly how each benefit is calculated and discover that factors such as business use, personal kilometers, and detailed mileage records can significantly affect the final taxable amount. The key takeaway is simple. A company-owned automobile can create two separate taxable benefits. Understanding the difference between the standby charge and the operating cost benefit is essential before attempting any automobile benefit calculations. One of the best ways to reduce automobile tax problems is surprisingly simple. Keep accurate records. When a company-owned vehicle is used for both business and personal driving, the CRA expects clear documentation showing how the vehicle was used throughout the year. The most important record is a detailed mileage log. A good mileage log records the date of each trip, the purpose of the trip, the starting and ending locations, the number of kilometers driven, and whether the trip was for business or personal reasons. It is also a good practice to record the vehicle's odometer reading at the beginning and end of the year. Keep receipts for fuel, repairs, maintenance, and insurance, and review these records regularly rather than waiting until year-end. These records help establish the percentage of business use compared with personal use. That information is essential when calculating taxable automobile benefits and supporting your calculations if the CRA ever asks for evidence. Now compare that with poor record keeping. If there is no mileage log, if kilometers are estimated instead of recorded, if personal trips are not documented, or if receipts are missing, it becomes much more difficult to demonstrate the actual business use of the vehicle. In those situations, the CRA may rely on its own estimates or disallow certain claims because there is insufficient supporting evidence. That can result in higher taxable automobile benefits, additional taxes, interest, and possibly penalties. For tax preparers, reviewing the mileage log is often one of the first steps in analyzing a company-owned vehicle. Good documentation makes calculations more accurate and provides strong support if the tax return is ever reviewed. The key takeaway is simple. Good mileage records are one of the most valuable tools for reducing automobile tax problems. Accurate documentation helps establish business use, supports the correct calculation of taxable benefits, and significantly reduces the risk of CRA reassessments.